In this video, we'll talk about whether long-term investors should think about buying Realty Income, the REIT that pays a dividend every month. Please give this video a like and subscribe to our channel to receive weekly updates before we begin. Let's get started. Realty Income, stock ticker, O, is well positioned to benefit from its portfolio, which comprises of major industries that sell essential goods and services and are less susceptible to economic uncertainties. Furthermore, the company is expected to benefit from accretive acquisitions and a strong balance sheet. This retail real estate investment trust, or REIT, has properties in all 50 U.S. states, Puerto Rico, the UK, and Spain. Most of the annualized retail contractual rental income comes from tenants whose businesses are mostly based on services, necessities, and low prices. Realty Income benefits from the steady income these companies bring in because they are less likely to lose money if the economy goes bad or if online retailers start to compete with them. This dependable company has endured the test of time. Investing in the stock market this year has been a roller coaster ride for investors. High inflation and rapidly rising interest rates have weighed on asset prices. The latest inflation numbers are out, showing that the Consumer Price Index, CPI, rose by 8.3% from August last year, higher than economists expected. There's no telling where inflation or the economy will go in the coming months. However, history tells us that quality companies that pay out dividends consistently can be an excellent source of income. One no-brainer dividend stock you can buy today is Realty Income, the real estate stock that pays investors a monthly dividend. Realty Income has a solid business that can weather economic storms. Here's why the company is so durable. Realty Income's high occupancy rate makes its business dependable. Realty Income is a real estate investment trust or REIT that purchases and manages properties through long-term lease agreements. It manages over 11,000 properties for clients, including CVS Health, Walgreens, Dollar General, and Dollar Tree. Realty Income uses a triple net lease with clients, which makes those clients responsible for taxes, maintenance, and insurance on the properties. This is a common way to lower tenant rents. Rents will go up and Realty Income's financial responsibility for a commercial property with only one tenant will go down. Realty Income reduces this risk by dispersing it across thousands of properties. Whereas this leasing model can be risky at the individual building level due to vacancy risk, it is either 100% or 0% occupied. Along with that, most of its largest clients have credit ratings that are regarded as investment grade. What makes Realty Income special is that it has maintained high occupancy levels on its properties for over 25 years. Going back to 1998, Realty Income has had a median occupancy level of 98%, outpacing other REITs in the S&P 500, whose median occupancy is 94% at the same time. How does Realty Income select its properties? Even during the Great Recession of 2008, when real estate and other assets took a lot of damage, occupancy rates have stayed the same for Realty Income. The REIT takes advantage of the fact that it has been in business for 53 years and is careful when making lease agreements. For one, the initial lease term is longer than average, at over 10 years. A longer initial lease term helps Realty generate more reliable cash flow over time. Another attractive feature is that nearly 86% of its leases have built-in rent escalators tied to inflation or fixed increases, which can also make this an attractive inflation hedge. 2. Realty Income can use its huge amount of data to analyze opportunities, both new and old, that look good. The company whittles down its investment opportunities by looking at long-term industry trends that show the businesses it leases to are sustainable. It also looks at the locations of its properties to make sure they have good qualities, like being close to big cities. For example, 85% of the population in the US lives within 3 miles of the company's pharmacy clients, CVS Health and Walgreens Boots Alliance. Walgreens wants to build 1,000 doctor offices by 2027. This gives Realty Income a chance to grow as its clients do. A safe dividend stock you can count on. Realty Income concentrates 84% of its portfolio on retail properties. One way to manage this risk is by diversifying across industries. It has the most exposure to grocery stores, which pay 10.5% of its annualized rent. Convenience stores and dollar stores pay 9.2% and 7.4%, respectively. This diversification and its strict selection process all add up to Realty Income being a dividend stock you can trust. For 27 years, Realty Income has been a dividend aristocrat for years because it has increased the dividends it gives to investors. The company's dividend payout ratio is 76.5%, which is a safe number that will let it keep its dividend and have enough money to buy more property in the future. With its 4.4% dividend yield and monthly dividend payouts, investors in search of passive income can't go wrong with Realty Income stock. Impressive and consistently growing dividends. It has also reached a milestone by raising its dividends for 100 quarters in a row, and it has raised its dividends 117 times in total. Realty Income is a great stock to buy for investors looking for long-term monthly dividend growth. Annually, Realty Income stock pays $2.98 in dividends, yielding an impressive 5.13%. Its forward-adjusted funds from operations, AFFO, yield stands at 6.96%. The company raised its monthly dividends by 5.1% year-over-year in June 2022. Furthermore, Realty Income distributed roughly 76.5% of its forward-adjusted funds from operation during the fiscal 2022 second quarter that ended in June. Strong financials. Despite the volatile macroeconomic backdrop, Realty Income has continued acquiring properties internationally. In the first half of 2022, the company invested more than $3.2 billion in high-end real estate across the United States and internationally. In fact, in the last quarter, Realty Income raised its acquisitions guidance to over $6 billion for fiscal 2022. Our second quarter results demonstrate the stability of our business and the continued momentum in our global investment pipeline, Realty Income President and CEO Sumit Roy said in a recent interview. Realty Income's real estate portfolio has remained strong despite the market fluctuations, as its occupancy rate stood at 98.6% at the end of the fiscal second quarter, the highest in 10 years. This marks a 40 basis point increase in portfolio occupancy rate year-over-year. Also, the company exited the fiscal 2022 second quarter with a 105.6% recapture rate on releasing activity, reflecting its strong market position. Robust growth ahead. Realty Income has focused on expanding its overseas portfolio for a while. To that end, the company recently raised its multi-currency revolving line of credit to $4.25 billion and its commercial paper program to $3 billion. This follows the company's acquisition of Dividend Incorporated last December, consolidating its position as a leading net lease REIT. Apart from projected inorganic growth, Realty Income is also restructuring its existing portfolio to boost rental income. In the first half of 2022, the company raised its annual new rent on releases by 5.8%. With a potential recession knocking on the door, stable dividend income has become one of the priorities of retail and institutional investors alike. The monthly dividend stock might be one of the best REITs to invest in for the long term as the market backdrop becomes gloomier. Its historical performance and strong balance sheet should allow it to withstand an economic downturn with ease. Do you think Realty Income is a good long-term REIT to add to your investment portfolio? Let us know in the comments below. And don't forget to like this video and subscribe to our channel for the best stocks to buy and cutting-edge investment strategies for building wealth. Happy investing and thank you for watching.